away the noise, the hype, and the fake promises and talk about real wealth, real opportunities, and real danger hiding in plain sight. Today, I'm going to show you why gold at 12,000 and silver at 1. 200 isn't just a number on a screen. It's a warning, a signal, and a massive opportunity that could redefine the future of your money. If you own gold, silver, are thinking about it, this episode will challenge everything you think you know about wealth protection. Markets are moving faster than ever. Central banks are quietly stacking gold. Industrial demand for silver is skyrocketing, and the world's economies are balancing on a knife's edge between inflation, rate cuts, and uncertainty that could shake even the most seasoned investors. And most people, they don't see it coming. By the end of this video, you're going to understand why positioning, timing, and strategy matter more than ever, how the super cycle in silver and the relentless accumulation of gold are signaling seismic shifts in the financial world, and why doing nothing today could cost you far more than you imagine tomorrow. So settle in, pay attention, and forget what the media tells you about safe markets or stable investments. Because in the next few minutes, we're going to uncover the truth that Wall Street insiders, bankers, and the mainstream press don't want you to know, and show you how the smart money is positioning itself while everyone else panics. I'm not here to sugarcoat it. I'm here to open your eyes, wake you up, and arm you with insights that could change the way you think about money forever. So grab a notebook, clear your mind, and let's dive deep. Because what you learn here could be the difference between losing your hard-earned wealth and protecting it through one of the most turbulent times in modern financial history. Trust me, by the time this video ends, you won't just be thinking about gold and silver differently. You'll be thinking about your entire approach to money, risk, and opportunity differently. And if you act smart, you can turn what looks like chaos into massive financial advantage. Stay with me, because this isn't just another market update. This is your roadmap to survival and growth in a world where the rules are changing faster than ever before. Right now, we are witnessing one of the most extraordinary periods in the history of precious metals. Gold and silver are not just rising, they are shattering expectations and hitting price levels that few analysts predicted even months ago. In 2025, gold has surged sharply, climbing well above previous benchmarks and staying elevated, demonstrating remarkable strength in the face of global economic uncertainty. This surge reflects deep structural shifts in global markets, not just short-term trading noise. Data shows gold's price rising more than 60% year to date and reaching levels above $4,300 per ounce, a level that a decade ago many would have considered unthinkable. Silver's story is even more dramatic. In 2025, silver has more than doubled in price, with the spot price climbing to historic highs above $65 per ounce. That kind of performance isn't typical of a metal that for years traded at lower levels. It signals extraordinary demand dynamics at play in a tightening supply backdrop. On December 17, 2025, silver reached a new record high around 60 and 152s per ounce before settling slightly lower, marking a stunning gain of over 120% for the year. Is behind these powerful moves. First, we are living in a period of growing macroeconomic tension. Softening economic data, including signs of a slowing U.S. labor market and higher unemployment rates, has pushed investors toward assets that act as stores of value when confidence in traditional financial markets wavers. The anticipation of further interest rate cuts by the Federal Reserve has weakened the dollar and lifted demand for non-yielding safe havens like gold and silver. When the dollar weakens, gold and silver become more attractive as alternative stores of value. And this shift is clearly playing out, and silver's rise reflects not only safe haven demand, but also real industrial demand. Silver is a critical metal and technologies that are central to the global energy transition, from solar panels to electric vehicles to electronics. As industries compete for limited supplies, the pricing mechanism responds. That competition is pushing silver prices to record levels, and inventories and major exchanges have been tightening. As a result, the fact that both gold and silver are rallying strongly together underscores a broader theme. Investors are rethinking traditional asset classes. With volatility in stocks, bonds offering low real yields, and geopolitical pressures simmering, precious metals are stepping back into their long-standing role as financial ballast. This isn't speculative exuberance. It's a shift toward tangible value when confidence in paper assets is challenged. Gold isn't just trading higher, it's reestablishing itself as a hedge against currency weakness, inflationary risk, and systemic instability. Silver isn't just rallying because gold is up, it's rising because real demand is surging while supply remains. In short, the price action we're seeing in 2025 isn't random. It's a powerful signal that the financial world is adjusting to new realities. Whether you hold these metals for protection, growth, strategic diversification, there's no denying that we are in a historic moment for precious metals markets. And the strength we are seeing today is likely to shape investment thinking far into the future. In 2025, something remarkable is happening in the financial world. Gold and silver are not merely rising in price. They are being actively sought after as fortress assets in a storm of uncertainty. Investors aren't buying these metals because they're trendy. They're buying them because deep structural forces are reshaping market priorities. At the heart of this surge is what financial professionals call safe haven demand, the impulse to protect wealth when the future feels unstable, unpredictable, and risky. And that pressure is building from multiple directions. First and foremost, geopolitical tensions remain elevated, and that continually feeds into investor psychology. Conflicts, trade disputes, shifting alliances, sanctions regimes, and global diplomatic friction all create an environment where confidence in traditional financial systems wavers. When markets fret about what tomorrow might bring, whether it's trade disruption, sanctions, or the geopolitical fallout of armed conflicts, investors instinctively shift toward tangible stores of value. Gold and silver have played that role for centuries because they are not tied to the fortunes of any one government or currency. Compounding that geopolitical backdrop is persistent inflation pressure around the world. Even as central banks attempt to engineer stability, inflation has stubbornly lingered above targets in many major economies. When inflation stays high, the purchasing power of cash erodes. Traditional savings accounts, bonds, and other yield-bearing instruments can lose real value after inflation is accounted for. In contrast, gold and silver do not yield interest, but historically they preserve purchasing power when inflation bites hardest. That characteristic turns them into a magnet for those looking to safeguard their capital. At the same time, markets are pricing in expectations of rate cuts, particularly by the U.S. Federal Reserve and other major central banks. When interest rates fall, the opportunity cost of holding non-yielding assets like gold and silver gets lower. In other words, if investors can't earn much from interest-bearing assets because rates are near zero or being cut, the relative appeal of precious metals increases. Rate cuts also tend to weaken the U.S. dollar. A weaker dollar boosts the appeal of commodities priced in dollars, including gold and silver, because it makes them cheaper for holders of other currencies and supports higher global demand. This convergence of global instability, inflation pressure, and monetary policy expectations creates the perfect storm for safe haven demand. Investors are not merely speculating. They are positioning defensively. They are protecting not just portfolios, but peace of mind. Physical bullion coins and bullion ETFs are seeing increased interest because people want assets that don't depend on counterparty risk. That is, they don't rely on someone else to honor a promise. That's exactly what gold and silver represent. Real value in hand. What's striking about this environment is how these forces overlap and reinforce one another. Geopolitical unease feeds inflation anxiety. Inflation worries support expectations of rate cuts. Rate cuts favor non-yielding assets. And all of this pushes more capital into precious metals. This isn't a fleeting phenomenon or a speculative fad. It's a global reassessment of financial priorities, and gold and silver are at the center of it. In short, safe haven demand in 2025 isn't just a market trend. It's a reflection of core economic shifts. Investors are seeking stability in an unstable world. And right now, Nothing embodies that stability more than gold and silver. Right now, silver isn't just sitting on the sidelines as a hedge against inflation or market turmoil. It is evolving into one of the most demand-driven metals on the planet because of its indispensable role in modern technology in the clean energy revolution. We are seeing in 2025 as a real industrial supercycle, not a speculative bubble, but a fundamental transformation of silver's role in the global economy. And this goes far beyond jewelry or coins. First, think about how the world is changing. The shift toward renewable energy is accelerating at a pace most people didn't expect just a few years ago. Solar power installations are expanding dramatically across continents, driven by policy commitments to reduce carbon emissions and the falling costs of photovoltaic technology. Silver is a crucial metal in solar panels because it's used in the conductive paste that captures sunlight and converts it into electricity. Even though manufacturers are developing ways to use less silver per panel, the sheer volume of new solar capacity being installed worldwide keeps total silver demand from this sector exceptionally high. At the same time, the electric vehicle EV revolution is underway. Unlike internal combustion engine cars, EVs rely heavily on electronics and electrical contacts, and silver is one of the best conductors of electricity in the world. It shows up in battery management systems, power electronics, charging infrastructure, and sensors that modern electric vehicles use extensively. With EV sales growing rapidly, silver demand from the auto industry has jumped significantly. According to industry data, electric vehicles use more silver per vehicle than traditional cars, which amplifies demand as EV adoption scales globally. It doesn't stop there. Silver's unmatched conductivity and reliability make it vital across many advanced technology sectors. Data centers powering artificial intelligence, cloud computing, 5G, telecommunications networks, Internet of Things, IT devices. All of these require components that use silver. In semiconductors, printed circuit boards, and other high-tech applications, silver's performance can't easily be replaced by cheaper metals. As demand for digital infrastructure increases, so too does silver's industrial footprint. This structural demand expansion is also happening against a backdrop of supply constraints. Silver isn't mined primarily on its own. Most of it comes as a byproduct of mining other metals like lead, zinc, and copper. That means even if prices rise sharply, supply can't quickly ramp up to meet surging industrial consumption. It's simply not responsive on short notice. The result, an ongoing structural supply deficit that is aligning with these powerful industrial demand trends. We Bush investor. All of this together, solar, EVs, electronics, tech infrastructure has shifted silver's narrative. It's no longer just a safety net or a portfolio diversifier. In 2025, industrial usage accounts for more than half of total silver demand, and that proportion has been rising steadily over the past decade. This structural shift is real, measurable, and fundamentally altering how markets price silver. In plain terms, silver's industrial supercycle means that its value isn't just about protecting wealth. It's about participating in the growth of the most dynamic sectors of the global economy. That's why we're seeing record prices, tight inventories, and sustained upward pressure on this metal in a way that goes far beyond traditional safe haven behavior. Right now, gold isn't just another commodity trading in global markets. It's being treated as the premier store of wealth on Earth. And that's showing up in real-world behavior from the world's biggest reserve managers and investors. Central banks around the globe are actively accumulating gold at levels unseen in decades, pulling metal out of circulation and placing it into vaults as a strategic asset that can't be debased, confiscated, or erased by monetary policy. This isn't a Fed or a short-term trade. This is a long-term repositioning of global financial architecture towards something that has stood the test of centuries. In 2025 alone, collective central bank gold holdings have climbed tremendously, highlighting a powerful global trend. Official institutions are treating gold as a cornerstone of monetary sovereignty. Emerging market central banks, including China's People's Bank of China, the Reserve Bank of India, Poland's National Bank, and others have been steadily increasing their holdings. Analysts estimate that many of these banks will finish the year having bought hundreds of tons more gold, continuing a multi-year string of net purchases. These purchases aren't occasional buys. They are strategic reserve allocations designed to diversify away from traditional currency reserves and hedge against geopolitical uncertainty. This move toward gold as a reserve asset reflects deeper shifts in global financial confidence. For decades, the US dollar and liquid government bonds dominated official foreign exchange reserve. But persistent geopolitical risk, including trade conflicts, sanctions, and currency volatility, has pushed countries to rethink how they protect their wealth. Gold, by contrast, has an intrinsic value that isn't tied to any single nation's monetary policy or political agenda. It cannot be easily frozen or devalued by policy shifts, making it an appealing anchor for national reserves. Investors, both institutional and individual, are watching closely. The dramatic rally in gold prices, including breaking through key psychological levels like 4,000 per ounce in 2025, reinforces the message: when official demand increases, prices respond. Exchange-traded funds, ETFs backed by physical gold, have seen strong inflows as well, reflecting broad investor recognition that gold isn't just for central bankers. It's a hedge for portfolios against inflation, currency weakness, and market stress. Gold ETFs surged significantly, highlighting how private investors are allocating more to bullion exposure in addition to official reserve flows. More importantly, the pace and consistency of gold accumulation by central banks has helped create a structural price floor. Sovereign entities with deep pockets and long-time horizons buy gold at scale. They reduce available supply in the market. And over time, that scarcity contributes to higher prices. Analysts cite this dynamic as a key underpinning for gold's record-breaking run. Gold's role today is more than symbolic. It's functional insurance. When economies face inflation pressure, when currencies weaken, when debt levels rise, when global trade relationships become unpredictable, gold becomes the asset investors turn to for stability. Unlike stocks or bonds whose values are tied to earnings or interest rates, gold represents real value that persists even amid financial turmoil. That's why both official institutions and private investors are increasingly allocating to it, viewing gold not just as a hedge, as a core component of long-term wealth preservation. In 2025, gold's stellar performance isn't an accident. It's the result of coordinated global demand, structural shifts in reserve strategy, and investor recognition that in a world of uncertainty, real tangible assets matter most. That's why gold continues to dominate as the ultimate store of wealth. In today's financial environment, portfolio strategy is no longer a theoretical exercise or something to consider casually. It is the difference between surviving and thriving in turbulent markets. Investors are realizing that the old rules of buy and hold are relying solely on equities are insufficient in a world where inflation pressures, geopolitical uncertainty, and shifting monetary policies dominate headlines. How much to hold in cash, stocks, bonds, gold, and silver, when to adjust those holdings is now a matter of survival and long-term financial resilience. For decades, investors could rely on equities to provide steady growth while bonds provided safety and predictable returns. Today, that paradigm is being challenged. Stock markets are more volatile than ever, reacting not just to company earnings, but to political tensions, currency fluctuations, and policy shifts across the globe. Bonds, once seen as the safe harbor, are yielding negative real returns in many economies when adjusted for inflation. In this context, holding precious metals like gold and silver has become a strategic necessity, providing a hedge against volatility while simultaneously acting as a store of value. But simply owning gold or silver isn't enough. Investors must consider allocation percentages carefully. Analysts now recommend portfolios where a meaningful portion, often 8-15% in gold and 10-15% in silver, is held to protect against systemic risks and market shocks. These allocations are not arbitrary. They are based on the recognition that precious metals perform differently from traditional assets and can act as a stabilizing force when equities falter. At the same time, investors must remain nimble, adjusting their holdings according to market conditions, valuations, and macroeconomic indicators. Timing also matters. Knowing when to buy or hold can determine the success of a portfolio. In periods of rising uncertainty, purchasing gold and silver at strategic intervals rather than attempting to time the absolute bottom allows investors to average costs and avoid emotional decision making. Holding during periods of market turbulence ensures that investors retain exposure to assets that historically preserve wealth. Selling prematurely can undermine long-term gains. This disciplined approach separates those who merely hope to survive from those who are positioned to prosper. Another critical aspect is understanding shifting risk appetites. Market participants are increasingly aware that traditional portfolios may not be resilient under stress scenarios such as currency devaluation, inflation spikes, or geopolitical crisis. Investors with a diversified strategy that includes tangible assets, liquid positions, and risk-managed equities are more likely to endure shocks. A portfolio that adjusts to personal risk tolerance while maintaining exposure to hedges like gold and silver provides a buffer against uncertainty and allows growth without overexposure to volatility. In short, portfolio strategy in 2025 is about precision, balance, and adaptability. Investors must assess how much of each asset to hold, when to increase or decrease exposure, and how to maintain alignment with long-term goals while navigating short-term turbulence. In this environment, financial resilience is not optional. It is a deliberate, disciplined approach to surviving uncertainty while positioning for growth. Those who take these principles seriously, allocating strategically, and adjusting intelligently emerge stronger regardless of how turbulent the markets become. So here's your real takeaway. Gold and silver aren't relics of the past. They are shock absorbers for your financial future. They shine not just because they are precious, but because they work when currencies wobble, markets shake, when uncertainty rises. If you own them, watch closely. If you don't, educate yourself before it's too late. Because in a world full of currency risk and financial noise, these metals are the quiet forces that could protect your wealth when everything else falters. This isn't speculation, this is strategy. Stay sharp, stay curious, and most importantly, stay in control of your financial destiny.